Chances are, if you've clicked on this video, you imagine two things when thinking of the stock market. Option one, you imagine a room filled with old men having boring and complicated conversations. Or option number two, you imagine a room filled with degenerate gamblers making high-risk decisions filled with hoes and questionable substances. The truth is, both are kind of right and both are kind of wrong. But in this video, we're going to explore what exactly is the stock market and how does it work. In plain terms, the stock market is a place where you can buy and sell small pieces of a company through what we call shares. Each share gives you a small ownership of that company. Now try to think of the stock market a bit like StockX. So number one, instead of trading sneakers, we're actually trading companies. Number two, prices fluctuate day to day based on supply and demand. And number three, you can both buy and sell on the marketplace. Now, unlike StockX, the stock market is only open Monday to Friday, 9 to 5. Now, a lot of people like to use the stock market as a measure on how well a country or an economy is doing. But considering there are thousands, if not tens of thousands of stocks, how do we use this to measure a country's or economy's performance? Well, this is where indexes or index funds come into play. Now, depending where you live, you've probably heard terms such as FTSE 100, FTSE 250, S&P 500, the Dow Jones, the Euro Stock 50. An index is essentially a list of stocks grouped together based on certain characteristics. So again, let's take StockX as an example. Let's say you wanted to measure the health, the demand health, the supply health of Nike trainers, for example. You could create the Nike index. In order to create the Nike index, what you could do is take the 100 most popular Nike trainers, regardless of what variant they are, and group them together to understand an average price and how that average price is fluctuating over time. As a result, what you have is sort of a health chart of how Nike prices are moving in general. And this is exactly the same as the stock market. If you take the S&P 500, all that is America's 500 largest companies. Now, there are two components to the stock market. You have the primary market and a secondary market. But the truth is, unless you're an investment banker or a high wealth individual, you'll never touch the primary market. But for educational purposes, we'll cover it in this video anyway. Now, the primary market is how companies first raise money. This is the first time a company will sell its shares to the public, and that's usually a closed group of investors. The company will sell X number of shares for a pre-agreed price, and this is what we call an IPO, an initial public offering. If you've ever watched Wolf of Wall Street, an example of this is the Steve Madden scene. Once the IPO has taken place, we move from the primary market to the secondary market. Now, in the secondary market, this is where that initial group of investors can freely buy and sell their shares to anyone. And again, I'm going to make comparisons to StockX because the parallels are crazy. So the primary market would be your initial drop. So going onto the Nike website, the Adidas website, the Supreme website, and doing that initial cop. The secondary market would then be taking your items which you've copped at retail and listing them on StockX, listing them on the secondary market where anyone can buy them. And of course, this is all done just to try and make a profit. But in the case of shares, we don't have StockX. What we have is the stock exchange, and the stock exchange is where we buy and sell these shares. To interact with the stock exchange, we have to sign up with a middleman, sometimes known as a broker. And just Google that because it will vary depending where you live. But some big names are Vanguard, Robinhood, Trading 212, and so on. As mentioned earlier in the video, prices will fluctuate over days, weeks, months, and years, depending on supply and demand. And this is because buyers and sellers are always haggling over new information, emotions, human behavior, and so on. As a result, we have two terms which are useful to know: quoted price, which is the buy now price, the sell now price, and then you have a target price, and that's, as it says on the tin, that's your target of where you want to buy the share, where you want to sell the share. Now, expected profits or confidence in a company is usually what drives the fluctuation in price. If confidence is high and expected profits are up, the price will go up, and vice versa with the price going down. However, external events can also affect the price of a share. An example of an uncontrollable event was COVID. During COVID, retail stocks plummeted, but pharmaceutical stocks went up. Now, there's a key piece of information here. Given profits, confidence, and external environment can all affect the price of the share, this is why people use shares as a measure of a country's health. These businesses which we find on the stock market, They're not just names on the screen which we're buying and selling. They all have a direct impact to our day-to-day lives due to the goods and services that they provide to the economy. Now let's take Apple as an example. Now you imagine if the Apple share price started plummeting, why would this cause fears in the US economy? Well, if the Apple share price started falling, this means investors sense danger. They could be expecting reduced profits, which may result in reducing staff, which also may result in price hikes. All of these are negative factors which could tumble into a recession. And this is exactly why we group together so many stocks into one list, one index, because that index is essentially a confidence factor on if we think the economy is going to do well or do bad. And that is the stock market summed up for a beginner. I hope you enjoyed the video. If you want more finance videos, make sure you subscribe and like.